Why do banks collapse? Banks look strong. They manage crores of money. They have buildings, branches, digital systems, and regulatory oversight. So how do banks collapse? How can institutions that hold public deposits suddenly fail? Is it fraud? Is it economic slowdown? Is it mismanagement? The truth is, bank failures rarely happen overnight. They build slowly, through risk accumulation. Most bank collapses are not caused by one single mistake. They are caused by multiple unmanaged risks coming together at the same time. Let us understand the real reasons why banks collapse in simple and practical terms. The most common reason banks collapse is excessive credit risk. Banks lend money. That is their core business. But if too many borrowers fail to repay, losses increase. When defaults rise sharply, banks must set aside provisions. This reduces profits. If losses are large enough, they start eroding capital. Capital acts as a cushion. Once that cushion weakens, confidence declines. In many cases, aggressive lending during boom periods creates future stress. When economic conditions worsen, weak borrowers default first. If credit appraisal was poor or monitoring was weak, losses multiply. Credit risk, when mismanaged, becomes the foundation of bank failure. Even if loans are good, liquidity risk can destroy a bank. Banks borrow short-term from depositors and lend long-term to borrowers. This maturity mismatch is normal, but it requires careful management. If depositors suddenly lose confidence and withdraw funds in large numbers, the bank must provide cash immediately. This is called a bank run. Even a solvent bank can collapse if it cannot meet immediate withdrawal demands. Liquidity crises spread quickly because fear spreads quickly. Once rumors begin, withdrawals increase. And once withdrawals increase, stress accelerates. Liquidity risk is about timing and confidence. When both collapse together, the institution becomes fragile. Another major reason banks collapse is weak governance. Strong banks have clear risk oversight structures. They monitor exposure limits. They escalate warning signals. They question aggressive growth. But in failing banks, risk warnings are often ignored. Management may prioritize rapid expansion over prudent control. Internal controls may be weak. Risk committees may not function effectively. Sometimes concentration risk builds. Too much exposure to one sector, one borrower group, or one geography. When oversight fails, risks accumulate silently. And by the time problems become visible, corrective action becomes difficult. Governance weakness amplifies financial risk. External shocks also contribute. Economic recessions reduce borrower repayment capacity. Interest rate increases raise funding costs. Market volatility affects asset valuations. Banks operate within the broader economy. If the economic environment deteriorates sharply, weak institutions struggle first. But here is an important insight. Strong banks survive external shocks. Weak banks collapse during them. External events expose underlying vulnerabilities. They do not create them entirely. Therefore, resilience depends on preparation before the crisis, not reaction during the crisis. So why do banks collapse? Because risks are mispriced, underestimated, or ignored. Credit risk builds quietly. Liquidity stress spreads quickly. Governance failures amplify weaknesses. External shocks trigger exposure. Bank collapse is rarely sudden. It is cumulative. And the ultimate driver is poor risk management. Strong banks focus on capital buffers, diversified lending, liquidity planning, and transparent governance. They balance growth with discipline because banking is built on trust. Once trust erodes, recovery becomes difficult. The lesson is clear. Banking success is not just about lending more. It is about managing risk intelligently. And institutions that respect risk are the ones that survive.